SoFi stock is the talk of the top of this video here today. We're going to talk SoFi. Anthony Noto is loading up on more SoFi shares, so we'll speak about that. Kind of want to share my perspectives and opinions on that, okay? Then I want to go ahead and react to this here. SoFi, the smart money is short. So we're going to react to specifically this part down here. We're going to go through their points. In a hard landing scenario, SoFi's accounting practices may lead to significant losses, potentially requiring capital raises, making it a risky investment. So I thought we would get into that. I thought that was an important one. And then after that, I want to react to just a lot of things going on in the market. We're going to go through a bunch of stocks and other just kind of moves that I'm seeing out there that I think are very interesting and worth paying attention to. So appreciate y'all joining me as always. I'm in New York City right now, so a little bit of a different videos I'm trying to produce this week overall than when I'm at home. But I appreciate you guys joining me. Thanks for being here. Make sure to subscribe to the channel if you're not already subscribed, which, let me think here for a moment. I don't even know how many subscribers we have on this channel, but I know it just keeps growing and growing. So I appreciate each and every one of you, okay? So Anthony Noto, CEO of the company of SoFi, right? He just loaded up on more shares, bought another 30,715 shares. He paid $6.48 for the stock. Now, I think there's a few things to keep in mind here, okay? First is there's many reasons why a CEO sells a stock. It could be because they need money to go buy a new mansion. It could be because they need money for taxes. It could be because they want to go buy a big yacht. It could be because they want to diversify their funds around. It could be because they want to give money to a family member. This could be a million different reasons why a CEO goes to sell a stock. But in terms of going to buy a stock, there's only one reason. And it's because you think the stock is very undervalued and you're buying that stock because you think you're going to make a lot of money on it. There's no other reason to ever buy a stock if you're a CEO of a company other than that. That's it. So the moral of the story is if Anthony Noto's out there buying shares of the stock and, a couple days ago buys 30,000 plus shares, it's probably because he believes it's going to be worth a whole lot more money than $6.48 in the future. Now, the second thing I want to point out here that might be just as important, if not more important than that, is look at this. If you see the price that Anthony Noto's been buying the stock at, it's very consistently, if we look at really the past couple of years, he wants his stock under $7 specifically. So given that there's no one, I believe, in the world that's going to understand this business model as well as Anthony Noto. No one. Okay, me or anybody else, and there's a lot of people that are great in the SoFi community. There's no one that understands this company better. No investor, no analyst, nobody than Anthony Noto. He understands this company on the highest level. So there's something specific about under the $7 level that the risk reward just screams, I have to get more shares of this stock. And all CEOs of their companies have certain valuations and prices in mind that they're like, if this stock goes to this price, I have no choice but to buy it because of just like, it's such a ridiculous value. I always remember Steve Wynn at Wynn Resorts. He had certain prices in mind that he just looked at Wynn stock and he's like, this is a screaming deal here. I've got to get more shares. And he would do open buys in the market. Now, he had a crazy amount of money. He was a multi-billionaire. So when he would buy for some ridiculous sums of money. It wouldn't be like $200,000. It'd be like, $200 million or $20 million or some crazy amount. But that was Steve Wynn. So in regards to this, these guys know their businesses better than anybody. They know what the real value is. And so there's something specific here with that under $7 level that he says, this is where I have to buy. So overall, do you look at this as a bullish or bearish catalyst? Certainly bullish, right? Does this mean the stock's going to magically go up tomorrow? No, absolutely not. Anthony Noto's been loading up on shares for 2 years. And look at the stock is still an under $7 stock, right? And the second thing I'll point out before we get into SoFi, the smart money is short, is SoFi is certainly, I think, kind of a laughing stock of this market right now, right? And just keep in mind, things can change. They can change, right? That stock is just, everybody kind of looks at it right now. It hasn't been doing anything. It's under $7, and it just kind of gets cast away, pushed off to the side. But things change very rapidly in the market. And so although that stock's been a laughing stock of the market, really, the past couple of years, don't think automatically it's going to be a laughing stock of the market the next couple of years. Things can change. Remember, Palantir was a laughing stock of the market just 2 years ago, right? No one wanted Palantir stock, it seemed. I wanted it. I was buying it, right? But most people, looked at that as just kind of a joke. And now people can't wait to run over themselves to buy Palantir at $24, $25, $26, right? And, a couple of years ago, people were paying $6, $7 for that. I mean, I have shares in my portfolios at those sorts of prices. So things can change. And so for SoFi, when the interest rate environment is more clear and the economy is a little more clear, SoFi could do very, very well in this situation. The next thing you know, people could be running over themselves to pay $15, $20, $25 a share for that stock. Whereas today, it's $6. So just a little food for thought in regards to that. But let's get onto the bearish side, because I think there's some points we got to talk about here. In a hard landing scenario, SoFi's accounting practices may lead to significant losses, potentially requiring capital raises, making risky investment for professional investors. In fact, the smart money perceives SoFi as the perfect macro hedge for consumer-driven recession. Ooh, okay. Look at this. Why is SoFi a perfect macro hedge? There's little doubt that if the U.S. economy goes into a hard landing coupled with higher unemployment, consumer-focused banks with a large unsecured book are going to experience materially higher delinquencies. Mr. Market is likely to shoot first and then ask questions later. SoFi has almost 70% of its loan book in unsecured personal loans. That is a highly concentrated book, but not the end of the story either. SoFi, compared to peer banks, has disproportionately higher exposure due to what is being perceived as aggressive accounting practices. SoFi employs an unusual accounting practice compared to its banking peers, where it elects held-for-sale accounting designation for its personal loan portfolio. This practically translates to upfronting of profitability from these loans compared to their peers on accounting treatment. Due to one, SoFi recognizes fair market value uplift on day one, typically of 4% to 5% of the loan assets. SoFi also does not provide for future losses as per the CECL methodology employed by most banks. So comparing apples to apples with peers, on day one of originating a personal loan asset, SoFi recognizes a benefit of 11 to 12% of asset value compared to peers' accounting treatment. Since the economic outcome and cash flow are the same, the day one gain reverses over the life of the asset, i.e. loan losses are recognized as they are incurred, and the fair market value bleeds back into the P&L, profit and loss, over time as an expense. I have explained this in more detail in an article. This recent tweet from Collins Porter highlights the concerns some professional investors have when it comes to SoFi accounting treatment. He says, might want to check the records on that. These big institutional investors see awful accounting. When they finally come clean, I'll be a buyer too, he says. So what if a hard landing happens? The fair market value, currently reporting a gain of $607 million, will likely reverse to a large extent or even turn negative. Similarly, the recognition of loan losses will likely be accelerated forward with higher loss severity. In such a scenario, it is implausible that a share price will plummet. Right? And so I don't know what they expect the share price to go to, 0, 1, 2, something like that, right? Concerns may also arise about its capital position and that SoFi may need to raise a significant amount of capital to shore up its balance sheet and capital ratios. The counter argument, before we get into the counter argument, first off, and I think this is important before we get into the counter argument, okay? At the end of the day, SoFi is a bank. Now, the reason, it's such a simple thing to say, but the reason it's so important is you have to understand these companies are extraordinarily scrutinized, and they have certain rules and regulations they have to follow, okay? Especially when it comes to assets to liabilities ratios and a lot of other things, right? And so what you got to understand is an article like this can make it sound like SoFi is just doing whatever, right? If you're not super well versed on what all these things mean, you might hear this and you might think, wow, SoFi is just a wild, wild west and they're just getting to do whatever they want. Doesn't work like that. If you're a bank, if you're a financial institution, you can't just do whatever the heck you want, right? There's a few little switches and changes you can make here, but at the end of the day, the Federal Reserve looks at a lot of this sort of stuff that's going on, right? When we're talking about everybody overlooking the entire banking system, these regulators are consistently looking at all these companies, right? It doesn't mean they can't go under, because we see banks fail, right? But you just got to understand this is a heavily scrutinized space. And so to try to make it sound like the Wild West is just not a reality, just to be quite frank, okay? And so I think I just need to say that first and foremost. Now, the counter argument from the bulls would be that SoFi borrowers have high FICO scores on average in the 740s, and that it has plenty of buffers with the current CET1 ratio of 17%. While the above counter arguments have some validity, I submit the following. One, in such a scenario, SoFi stock may sell off hard due to uncertainties with respect to fair market value and or the level of reserves needed. Mr. Market tends to shoot first, ask questions later, and thus SoFi management may be forced to act by the markets and or regulators. That's true. I can't push back against that. If the market got incredibly freaked out and it wanted to sell these stocks off, and it sold off a SoFi, to $3 or something like that, I can't argue against that. That's always a potential. That's always a possibility, right? Like what are you gonna say to that? I can't. There's no debating that. Like that's possible, right? But I could say that for a lot of stocks in the market, right? And if they could crash 50+% if the market, got into some situation where it was just sell everything by any means necessary, right? Number two, the report of 17% CET1 is somewhat inflated by the above-mentioned accounting treatment. Professional investors would adjust that figure for CECL and fair market value to reflect a much lower adjusted number. Back of the envelope calculation assuming 6% CECL and reversing $607 million of fair market value gain yields, CET1 of 9%, and thus arguably too low for such a highly concentrated bet on unsecured personal lending. Final thoughts. For some professional investors, shorting SoFi is almost a perfect macro hedge on a consumer recession. SoFi is expensive by traditional metrics, tangible book value, utilized by most banking investors. To push back against that, remember, SoFi is very high growth financial institution that is really kind of leading the way with the newer generation. And so, take that for what it is. So overall, I don't think they have bad opinion there. I appreciate that gentleman's opinions in kind of what he brings out there. With that being said, would a lot of bank stocks crash in some sort of major recession with higher unemployment? Sure. That's what happens. That's what happens in a recession. Go back to the great financial crisis. I mean, gosh, there was financial institutions, down all over the place, going under completely, right? And then there was a ton of others that were getting hit 40, 50, 60, 70%. So that's just a risk you have to be willing to take. I mean, to be quite frank, it's a risk you have to be willing to take in the market in general, and certainly in regards to these sorts of stocks. And so that's why SoFi, for me, right, is a very, very small position. I'm looking to add more SoFi shares over likely this next few months, but it has to be a small position for me. SoFi can't be a massive position. No financial can. If you told me I had to make a massive position in a financial institution, I would go JP Morgan. But there's not going to be a ton of upside growth there for JP Morgan at this point in time. So that's not very attractive to me, right? SoFi is attractive because you get that potential, 2x, 3x, 10x over the coming years, as long as they make it through the storms and those sorts of things. And it sounds like Anthony Noto's playing it safer than not. And so I don't know, and I'll push back once again on the notion of like SoFi being this Wild West, because there's a lot of things Anthony Noto and the management team could be doing right now to really push the business if they really wanted to in a very risky direction, and they're not doing that. So But at the end of the day, financial institutions come and they go. And so could SoFi go under in some dramatic situation? Sure. And that's why it's got to be a smaller position for me, right? But I mean, honestly, a lot of the differences between a SoFi and let's say a Wells Fargo or Bank of America or JP Morgan Chase is the government wouldn't let those big dogs fail. They would let SoFi fail. So that's the other important thing to remember. Those other big financial institutions are really, unfortunately, too big to fail. So they can't let them fail. But a SoFi, if they really wanted to let that fail, they would let that fail. They would have no problem with that, right? So I think it would be bad for the banking system overall for the long term because I think you need innovators like SoFi to stay in the space. But anyways, that's kind of, that's that situation. And once again, I think the bet for a lot of these folks isn't really about SoFi going under. It's more like SoFi goes to $3 or $4. I think that's more the play there, right? Now, with that being said, let's talk about the market a bit here because I think there's a lot of interesting things going on. And it starts right off the top with NVIDIA. So I'm watching NVIDIA today, right? And first off, the stock was, just being a beast like it is pretty much every day, right? And opened at 140 a touch, and it's just kind of weakened and weakened and weakened. But what's interesting? I was just thinking like an hour or two ago, I'm like, these people, they can't help themselves when it comes to NVIDIA. They're going to buy the stock right back up, right? And sure enough, here it's bottomed here recently and it's starting to come back to life. But I mean, at the end of the day, when it comes to NVIDIA, you get some sort of big upward move, then you get some investors to sell, right? And then as you get more investors to sell, then you get some stop losses start and get hit, right? So let's say you were out there buying it at 140 today, you think it's about to make its move to 150. You might have put a stop loss on it if you're a trader at, let's say, 137, 136. So next thing you know, it hits 137, stock gets sold, right? And then somebody else's, that causes more downward pressure, somebody else's stop losses get hit. And so you can kind of get a pretty dramatic move. And that's why you got the stock all the way from 140 all the way down to 130 today, or just under 130. Right? All in a matter of a few hours on the back of no news. But at the end of the day, people can't wait to own this stock. And so it's one of those stocks that it seems like every dip ends up getting bought. And don't be surprised if this is 140, 145, 150 here very soon, right? Apple getting hit a bit today, Tesla getting hit, MU getting hit unusually hard, but MU has been a very hot stock. I mean, you want to talk about a hot one. Check this out, man. 77% gain so far this year. Remember, MU is pretty much the biggest memory chip play. NAND and DRAM, baby. Oh, yeah. And they're seen as a huge beneficiary from these AI chips. The need for more memory overall. And so the market for MU looks pretty darn good, at least, for the next little bit of time here, right? And then it eventually reverses. MU is a funny company. It's very cyclical. They go through these time periods where they're making so much money, they don't know what to do with it all, right? And then they go through these other times where all of a sudden they become unprofitable or they start making minuscule profits. And, it's like that for a year or two. And then they come back and then they're making a fortune again. And then all of a sudden it's bad times. Very, very cyclical company. Very similar to some oil and gas companies, just to be quite frank. And then you look at AMD today. AMD's having a phenomenal day. While NVIDIA's struggling out there, AMD's doing just fine. I mean, that stock's up 4.8%. Salesforce having a great day as well, 4.7%. PayPal actually finally having a decent day. But you know what I said with PayPal? With PayPal, what do we know? And by the way, I did a very in-depth video on the main channel last night. If you don't follow me on the main channel, Financial Education. And I did a very in-depth video on PayPal, and I talked about a ton of different things in that one. But that stock, at the end of the day, they sell the stock off to, the 50s, right? High 50s. Then they buy it up, and next thing you know, it goes to 65, 67. Then they sell it off again, and then they buy it back again, and then they sell it off again. And so they've just been using this as a trading vehicle until I kind of feel like this is a little bit in the SoFi camp from the perspective of everybody is waiting for more clarity on rates when it comes to a lot of these stocks, man. And until people become confident in where rates are going, it just seems like a lot of these stocks are just floundering. And it's kind of just what we call in the market churn. And it caused a lot of frustration from some investors because they see the stock make a move, they think it's going to continue that move, then it gives it all back, and then they get, frustrated and disillusioned, and then it comes back again, and then it does the same thing again. And then it also leads people to start thinking maybe I should trade the market. That's the other problem. That's a big problem. Because people start thinking, you know what? Why would I think about holding PayPal for the long term? I had thoughts of the stock being $120 stock, 150, 180. Oh, who cares about that? I'm just going to play PayPal. I'm going to buy it at 59, ride it to 65, and get out, and then get back in. Usually when everybody starts thinking like that, that's when it actually makes its continued run. People never get to get back in it, and then it makes its run to 100 plus, right? And so, that's what happens in the market. You get into this frustrating kind of time period, right? Now, we'll go ahead and look at safety stocks here today. Actually AI stocks. Yeah, let's look at AI stocks in general. NVIDIA is the worst of the bunch here today, and AMD is the best of the bunch when it comes to AI stocks. Trade Desk has been interesting. That one is one you thought, might be struggling a little bit this year, but it's not at all, right? There we got Palantir chilling out at 25.58 here today. Palantir sitting on a 50% plus move so far this year. Been a very good year to be a Palantir shareholder. Congrats all my fellow Palantir bulls out there. If we look at my possible buys watch list here, let's take a peek. So looks like Zoom is the best of the bunch here today. I did just start a Zoom position here recently, as in, what was that, Friday? I think was the first Zoom shares I bought, which, yeah. Oh, do I even have Zoom? I need to add that onto my my list. I don't think I even have Zoom on there yet. It's such a new position. Yeah, I need to add it. Here we go, baby. New stock. Just bought my first shares back on, what was that, Friday? So we need to add that baby on there. There we go. Zooming. So, yeah, Zoom, just had a very stable business model. Obviously, great income statement, great balance sheet on that company. I mean, pretty extraordinary. So they're in a pretty good position here. Wynn's been another stock. They could put in. I would put them into the PayPal category, the Sofi category, even though it's a obviously luxury resort company. This is another one that people feel like until there's clarity around rates, they don't feel comfortable. Now, I did just see in Vegas. So Wynn has a piece of land that is right across the street from Wynn and Encore, and from my understanding, they want to eventually develop a third tower on that particular piece of land with more convention space and another gaming floor, and I'm sure some restaurants and things like that, right? But in regards to that, from what I understand, Vegas, the city of Vegas, just kind of allowed basically Wynn to keep the proposed project on hold until 2026. So that gives Wynn more time to maybe make a decision here. But it seems to me like Wynn is waiting on the Middle East property to be done. They're building a property in the Middle East that's supposed to open in 2027. From my understanding, construction is going very well on that, right? And that's a huge opportunity. And then from my understanding, they're also trying to get clarity from the city I'm in right now, New York City, right? Because they want to do a grand project in Hudson Yards. And I think they're trying to get some more clarity around that. Unfortunately, New York City doesn't work the fastest when it comes to some of these sorts of decisions. But I can tell you, if they do get New York City, then I think they'll probably sell the land off. I think they'll probably sell that piece of land off in Vegas, because that would basically mean they got the Middle East project going. Simultaneously, they got the New York project. And so I don't think they'd want to fund a third tower in Las Vegas. Now, if New York City doesn't work out, then in that situation, I do believe Wynn would build a third property in Las Vegas. Okay, so just some kind of food for thought in regards to that. As far as some of these other stocks I hold here today, a lot of the small ones are just struggling, right? Look at Avant today. Look at Revolve, $15. Look at Fubo, still $1, just floundering. And so a lot of those kind of riskier small caps just not doing a thing. Honest stuck at $249 right now. I mean, that stock's very actually appetizing. I mean, for the first time in a long time, I actually feel like buying Honest shares. And that's honestly amazing, because there was a moment actually probably last year where I thought there would never be a time where I bought Honest shares again. I thought I would only be a seller of that stock. but they've turned around the financials so fast that I'm actually considering buying the stock. And like I said, I never thought that would happen. Never. But it's happened. Now, if we look at the Russell down a bit here today, which the Russell hasn't done a thing. Where's Tom Lee at, man? Tom Lee and his call, small caps, supposed to be rolling this year, right? He was talking about his big call going in this year of small caps. He's talking about 50, 60% up. And here we are with a Russell that has done nothing this year. Absolutely nothing. And to be quite frank, this Russell hasn't done anything in years. I mean, heck, you go back to even prior to Rona. Let's see where the Russell was at prior to Rona. It was right around here. I mean, heck, since before Rona, the Russell's only up 19.7%. That's insane. That's insane. Oh my gosh. Now, that's crazy to me. That's crazy, right? Now, if we go back to kind of late 2021, the Russell's actually down significantly, down 14% from late 2021. And then if we go all the way to, or no, this isn't even late. This is early 2021. I'm sorry. This is from early 2021. Oh my gosh. Jeez. Right? Huh. And then from late 2021, down 17% from there. And then from when the Fed, at the beginning of 22 is when people started worrying about the Fed raising rates. And since that time, the Russell's down about 6.5%. So I think that's pretty interesting there, right? Now, let's see, commodities. So we got cocoa down, big, lumber down, pretty big, 3.7%. Oats are down, corn down, wheat down, soybeans down. GSG is what we all need to keep in mind. And GSG has been pretty chilling, here for the last, we can call it 4 months, roughly. Not too much happened in the last 3 or 4 months. Really, we'll say more toward 3 months. Last 3 months, GSG is not really doing much, and so that's good news for us overall. We don't want to see that rolling. Also, WTI, also not doing too much the last 3 months, which is also good news for us overall. We don't want to see, WTI go through some major bullish cycle. It's had a pretty big move from 73 at the beginning of June to here, but at $81 for, I'm recording this video June 20th, we'll take $81 a barrel. In middle to late June, we'll take that all day, every day. Anytime you can get to this time of year and you're under 90, you're looking really good, really good. So I'm happy with that overall. And that's going to help, obviously, when it comes to inflation data over here. So I just think that's a little food for thought there, folks, okay? Alrighty, guys, appreciate you joining me here today, as always. If you're looking to get access to 1000X stocks, so you can compare stocks, figure out if you're getting ripped off on a stock, if you're getting a great deal, listen to conference calls. We're working on SEC filings right now, all that good stuff. Then you can click the pinned comment down there. And the first pinned comment will be for access to 1000xstocks.com. And then if you're looking to apply to join a private group, get access to all my premium courses, Discord chat, all that good stuff, exclusive videos, second pinned comment. Much love and have a great day.